Okay, let's talk about a situation nobody ever wants to be in. You've been in a car wreck. Thankfully, you're okay, but your car, well, it's seen better days. Then you get the call from the insurance company and they drop the bomb. Your car is totaled. Now, the real battle begins, figuring out what they're actually going to pay you for it.
And this right here is what everyone's afraid of, isn't it? This quote just hits the nail on the head. You get that feeling in the pit of your stomach when the check they offer just isn't enough. It's not enough to buy a car like the one you just lost. And sometimes it's not even enough to pay off the loan on the car that's now a heap of metal.
So that's what we're going to break down right now. We're going to tackle these two massive questions. First, we'll pull back the curtain on how these insurance companies come up with their numbers in the first place. And then, and this is the most important part, we'll walk through exactly what you can do to fight for what your car is really worth.
Right off the bat, you need to understand something. The whole system is kind of designed to be confusing. Insurance companies have their own secret language, their own methods for figuring out a car's value, and it can feel like you're trying to crack some impossible code.
You see those words? Esoteric, careful not to reveal? It's a black box by design. They're using data and systems that you, the average person, can't just go and look up. So what does that mean for you? It means you're walking into this negotiation at a serious disadvantage. But don't worry, we're about to change that.
Okay, so let's get into the nitty-gritty. Before we can even argue about the money, we have to understand how a car gets slapped with the totaled label to begin with. It's not just about whether the car can be fixed. It's all about whether your insurance company thinks it's worth fixing.
Check this out. It's all about a simple but brutal calculation. An insurer calls it a total loss when the repair cost hits a certain percentage of the car's value. That magic number, the total loss threshold, is usually somewhere between 51 and 80%. So in this example, the repairs are 12 grand for a 15 grand car. That's 80%. So if you're in a state like Alabama, where the cutoff is 75%, boom, that car is officially totaled. It all comes down to that percentage.
So your car is totaled. The insurance company has to cut you a check, but for how much? They owe you the actual cash value, or ACV. And listen, this is the most important term in this whole process. Let me say it again because it's crucial. ACV is not what it costs to go out and buy a similar car. It's what your specific car, with all its dings and mileage, was worth the second before the crash.
So how do they cook up this ACV number? Well, they look at everything, and I mean everything, that can possibly lower the value. You've got the obvious stuff like year, make, and mileage. But they also look at all the wear and tear. And yeah, they can literally dock you for stuff like old soda stains. Every single one of these points is a little knob they can turn to dial down your final payout. The system is designed to find the absolute lowest number they can justify.
And this chart just lays it all bare, doesn't it? It's two completely different worlds. ACV, which is what your standard policy pays, is all about the past. Your car's old, depreciated value. It helps the insurance company. But what you need is the replacement cost, what it takes to get you back on the road in a similar ride. And there's almost always a painful gap between the two. And if you want to know why that gap is so big, you have to understand the monster that is depreciation. The very second you drive a brand new car off the dealer's lot, bam, it can lose up to 11% of its value. Instantly, just like that.
And it doesn't stop there. Not even close. After just 1 year, that shiny new car has lost about a fifth of what you paid for it. Gone. This is the brutal, relentless math that makes that actual cash value check feel so shockingly low.
Look, getting a low check is frustrating, but for some people, it spirals into a full-blown financial crisis. This is what we call the debt trap, and it happens way more often than you'd think.
So here's how this nightmare unfolds. It's a simple, painful chain of events. You buy a car, maybe with not a lot of money down. Then it gets totaled. The insurance company's ACV check comes in, but it's not enough to pay off your loan. That leftover amount is called a deficiency balance. And guess what? You are on the hook for every single penny of it. You're now in debt for a car that's sitting in a junkyard.
And don't think for a second they'll just let it go. Since the car itself is gone, your loan is now unsecured debt, and lenders can get really aggressive about collecting it. We're talking wage garnishment. The stakes here are incredibly high. This isn't just about losing a car. This is about a debt that could follow you around for years.
Okay, that was heavy, I know. But here's the good news. You are not helpless. There are ways to shield yourself from these financial disasters. The key is you have to plan for it before an accident ever happens.
You've basically got two main options here. First is replacement cost insurance.
It does exactly what it sounds like. It pays for a new, similar car, and it totally ignores depreciation. The catch? The premiums are a lot higher. The much more common solution is gap insurance. It has one very specific job, to pay off that nasty deficiency balance we were just talking about. It covers the gap.
But what if you don't have that extra coverage? What if you're in the middle of this mess right now, staring at a lowball offer? You are not out of options. It is time to talk about how you fight back.
So here it is, the million-dollar question. Can you actually push back? Can you tell the insurance company their offer isn't good enough? The answer is 100%, unequivocally, yes. Their first offer is just that, an offer. It's the start of the conversation, not the end of it.
All right, here's your game plan. This is your checklist. First, do your own research. Go to sites like NataGuides and find out what your car is actually selling for in your area. Second, know the rules in your state. Third, bring the receipts. Literally. Did you just get new tires? Have you kept meticulous maintenance records? Show them the proof. And finally, if their offer is way off from your research, don't be afraid to hire your own independent appraiser.
Look, going up against a huge insurance company can feel intimidating. It feels like they hold all the cards, like they wrote the rules to a game you're forced to play. But here's the thing. Now you know the rules too. You understand actual cash value. You get how depreciation works. And you have a checklist to build your case. The power isn't just in their hands anymore. So the only question left is, are you ready to play?